Welcome to FatCity Finance. Today we're going to look at Jamie Dimon's latest warnings about the economy. Before we begin, please take a moment to like, subscribe and ring that notification bell. Jamie Dimon, the esteemed CEO of JPMorgan Chase, has raised a red flag about the economic outlook for the coming years. His insights are highly valued in the financial world due to his vast experience and proven track record in navigating economic ebbs and flows. Dimon's concerns range from geopolitical risks and the potential impact of inflation to the effects of quantitative tightening by the Federal Reserve. He believes that the stock market's recent performance may be causing investors to overlook these imminent risks. It's important for us to understand these warnings and what they could mean for the economy. Jamie Dimon, CEO of JPMorgan Chase, has expressed caution about the U.S. economy in the next 2 years. Dimon, a seasoned player in the world of finance, has outlined a series of economic concerns that he believes could impact the U.S. economy. One of these concerns revolves around financial and geopolitical risks. He's specifically worried about the situation in Ukraine and terrorist activity in Israel. These events, he suggests, could have rippling effects that reach far beyond their respective regions, potentially shaking global markets and impacting the U.S. economy. Now let's talk about inflation. Inflation, for those who might not know, is the rate at which the general level of prices for goods and services is rising. Dimon expressed concern about the potential impact of inflation on the economy. A high inflation rate can erode purchasing power, which can lead to economic instability. Dimon is cautious about this, suggesting that if not monitored and managed properly, inflation could become a significant issue. But that's not all. Dimon also mentioned the Federal Reserve's quantitative tightening. This is a policy where the Federal Reserve starts selling off its securities to shrink its balance sheet and raise short-term interest rates. This can slow down economic activity and, according to Dimon, is another factor that could influence the U.S. economy in the coming years. Finally, Dimon voiced concerns over the recent performance of the stock market. He believes that the market's strong performance has led investors to overlook these potential risks. In essence, he's cautioning against complacency, urging investors to consider these looming threats when making their investment decisions. Dimon believes that the recent performance of the stock market has led investors to overlook these risks. It's a sobering warning from a man who knows a thing or two about finance, but as always, knowledge is power. By understanding these potential risks, we can make more informed decisions about our own financial futures. One of the key concerns raised by Dimon is the quantitative tightening by the Federal Reserve. So, what exactly is quantitative tightening? Well, it's practically the opposite of quantitative easing, which is when central banks pump money into the economy to stimulate growth. Quantitative tightening, on the other hand, is when central banks do the reverse. They suck money out of the economy primarily by selling assets like government bonds. The goal is to control inflation and stabilize the economy. But here's the catch. While this might sound like a good idea, it can have some unintended consequences. When money is taken out of the economy, it can lead to higher interest rates, making borrowing more expensive. This could potentially slow down economic growth, as businesses might be less likely to invest in new projects and individuals might think twice before taking out loans for houses, cars, or education. Now let's talk about inflation. Inflation is when the general level of prices for goods and services rises, eroding purchasing power. In other words, your dollar buys less than it did before. It's kind of like a hidden tax that chips away at your money's value. Currently, we're seeing some significant inflation numbers. This means the cost of living is going up, and if your income isn't keeping pace, you could be feeling the pinch. It's not just about paying more for a gallon of milk or a loaf of bread. It's about how these increased costs can add up and make it harder for people to save or invest for their future. Dimon's caution around these issues signals a potential shift in the economic landscape. So while quantitative tightening and inflation might seem like abstract concepts, they have real-world impacts. They can affect everything from the interest rate on your mortgage to the price you pay for groceries. And that's why it's so important to keep an eye on these economic indicators and understand what they could mean for your financial future. Dimon isn't alone in his concerns about the U.S. economy. A chorus of voices from the financial world are echoing similar sentiments. Let's take a moment to consider some of these other voices of caution. One prominent figure who has expressed similar economic concerns is Goldman Sachs CEO David Solomon. He shares Dimon's apprehension, particularly regarding the ballooning U.S. debt levels. If you recall, Solomon has been vocal about the fact that this growing debt is not a problem that can be ignored. He's been quoted saying the U.S. fiscal situation is not sustainable. And he's not wrong. The national debt is increasing at an alarming rate, and it's a ticking time bomb that could have significant ramifications for the economy. It's not just the size of the debt that's worrying, but also the speed at which it is growing. With each passing year, the debt-to-GDP ratio continues to rise, painting a grim picture of the nation's financial health. This is a clear indication that the country is living beyond its means, spending more than it's earning. Moreover, the issue of growing U.S. debt levels isn't just a domestic concern, it has international implications as well. The U.S. dollar status as the world's reserve currency is underpinned by the faith that other countries have in America's ability to pay its debts. If this faith is shaken, the consequences could be severe. In essence, Dimon and Solomon's concerns are intertwined. They both highlight the need for a more prudent fiscal approach to safeguard the economy from potential shocks. Whether it's the risk of a geopolitical crisis, inflation, or the growing debt levels, these concerns underscore the importance of preparedness. These warnings form a collective call for more awareness and preparation for potential economic shifts. This isn't the first time Dimon has warned about potential economic turbulence. Let's wind back the clock a bit to the year 2022. Dimon back then had raised a red flag, cautioning about an impending economic hurricane. Now, what exactly did he mean by that? In essence, he was pointing to a storm of financial instability, a whirlwind of economic disruption that could potentially rattle the markets and cause significant downturns. He voiced this concern in light of various geopolitical and financial factors that were at play. Now let's see how things unfolded. The year 2022 did indeed witness some turbulence, the markets were volatile, and there were moments of uncertainty. But was it a full-blown hurricane? Well, that's subjective to one's perspective. The economy did experience some shocks, but they were not catastrophic. However, it's worth noting that Dimon's warning wasn't off the mark. His predictions did bear relevance to the economic events of that year. He had accurately highlighted the potential risks and vulnerabilities that could and did affect the economy. These past insights lend weight to his current predictions. His track record of accurately identifying economic trends and potential pitfalls makes his recent cautionary statements all the more significant. When someone like Jamie Dimon, with his wealth of experience and keen economic foresight, issues a warning, it's certainly worth paying attention to. Dimon's past warnings have often been proven right, making his current predictions all the more significant. So, as we navigate the financial landscape of the coming years, it's crucial to keep these insights in mind and prepare for any potential economic storms that may be on the horizon. Jamie Dimon's latest warnings about the economy call for caution and preparation. It's evident that staying informed, analyzing trends, and preparing for different scenarios are crucial in navigating these uncertain economic times. By understanding these economic forecasts, we can make educated decisions, whether in personal finance or investment strategies. Remember, knowledge is power, and staying updated is key to weathering any economic storm. Thanks for watching, and as always, happy investing. Don't forget to like, subscribe, and ring that notification bell to stay updated with the latest from FatCity Finance.